Hello, everyone, and welcome to our seminar series. This is the first part of two series seminar where we are going to discuss some very interesting topics. And here with us, we have our GFS students, as well as Yanis Hadikias and Douglas Luxton. So, as you may know, this summer, we had the Global Forecasting School's summer school, which is still taking place in Dilijan, Armenia. And this is the second last week. And next week, we're going to summarize the summer school. And now our students are going to present their projects and what they have been doing during the summer. And Yanis and Doug are going to give some comments and we'll ask them some questions. And actually, Doug and Yanis are going to start. So without further ado, maybe I can just pass the floor to them.
Do I go first, Doug?
Please.
Okay. Hello to everybody. Looking forward very much to these presentations that we are going to hear. Just a few introductory remarks from me. I just wanted to give you my thoughts about how models are used or should be used in framing monetary policy. My own personal view is that some of the standard models that are used recently to guide monetary policy have not been entirely appropriate. Uh, I have in mind typically various variants of BSG, new Keynesian models that are, have been the workhorse, let's say, models of used by central banks. Um, they uh, they certainly have very valuable elements in them, but the main drawback in my mind is that they essentially tend or pretend, let's say, to provide uh, a picture of how the overall economy, macroeconomy works, and therefore may provide the illusion that they can give very unambiguous, straightforward answers to on how to assess the economy, where the economy is going, and what the appropriate policy response to the state of the economy should be. I hasten to say that central banks usually have better judgment than to take these models as given. So they have made judicious use of them, but at the same time, uh, they can obscure important things. In trying to provide such an overarching picture of how the economy works, they very often have to rely on very simplifying assumptions and even ignore whole areas or factors that can be highly relevant. Uh, among key weaknesses of these models as they have been used, uh, they have tended to provide a very simplistic or even ignore uh, uh, the ways that financial markets interact with the real economy. They had very little to say about asset markets. They very typically uh, impose the assumption that assets are that there is perfect substitutability between assets, uh, and, uh, and therefore can provide very misleading answers sometimes depending on circumstances. For instance, uh, in my mind, it was not a surprise that most of these models failed to even give a sense of the impending global financial crisis that was obviously a major problem. s- on the other hand, I have to say that models appropriately used can be extremely valuable. But in order to do so, they certainly should not try to or pretend to replicate reality, macro reality as a whole. As the saying goes, they have to recognize that all models are false, almost by definition. Uh, they have to be very targeted in what they do. Uh, they they are meant to appropriate models. I think are meant to elucidate particular important economic intuitions, ideas, and underlying mechanisms. Uh, and in that sense, they can be very valuable in ensuring the consistency of the underlying economic arguments and especially clarifying the underlying assumptions that drive the results of each particular model. Uh, I have in mind, for example, uh, the older generations of models uh, in the tradition of, for example, some of the papers that actually we discussed earlier this summer, the Tobin formulation of asset markets, the dynamic inconsistency papers that were meant to shed light on particular difficulties that could face monetary policy making. But even some more recent models, I think, are very important. For example, the Dornbusch overshooting model is a good example of a very uh, 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 well-specified model just to shed light on a particular important problem in a very clear way, in my view. But even more recent models like uh, models uh, of safe assets and the scarcity of safe assets and their macro implications. Um, Models formulated in this way can be also very valuable in helping to guide the judgment by policymakers, uh, in the sense that they, given that they are very transparent in terms of their assumptions, the policymakers can judge whether these assumptions are likely to hold or not in particular circumstances, and also given given that they provide streamlined arguments of specific mechanisms, they can help policymakers uh, uh, understand or evaluate whether the particular factors that are emphasized are relevant in the current circumstances or not. Another area where appropriate modeling can help a lot is to emphasize the importance of fundamental uncertainty that's very often involved in policy decisions and help policymakers incorporate this type of uncertainty into their policy decisions. Um, uh, so they can help policymakers incorporate in a very explicit way the likelihood that the assessment of macroeconomy can be wrong, as is very often the case, and therefore base policy decisions on assessing the implications of their being or of their making a mistake, a policy mistake. This is essentially the sometimes referred to as the policy of least or as the least regrets approach to monetary policy making. Um, Another, of course, way is to understand how to incorporate expectations, market expectations in policy making. Of course, market expectations are important because in formulating policy, in the sense that the people who hold these expectations, the agents who hold these expectations, are going to set wages and prices. So it's important to take them into account. But at the same time, it's important to evaluate what the monetary, the macro implications of expectations being wrong are likely to be. So if markets expect inflation to be very high and set, for example, prices and wages high, but the economy may be entering a recession, there could be specific and important implications that policymakers should take into account in formulating policy, and vice versa, of course. Now, after these very brief remarks, I must say I look very much forward to the presentations of you guys. As on the one hand, there are important areas of uncertainty at this point on the US macro outlook. So I would very much I look forward with great interest to your assessment and the policy implications that derive from them. In addition, and secondly, as I understand, the second presentation is going to focus on appropriate inflation target variables that a central bank should monitor. What are the pros and cons? Why are specific concepts of inflation important? Again, in the context of this general uncertainty, this would be an extremely important contribution. So with that, I give the floor to Doug, and I'm looking forward to all your discussions.
Okay, thanks, Yanis. And just let me begin by saying how impressed I am with all the students, their work over the last summer. We've been testing them every day, and it's been really wonderful to see the progress. I wanted to talk a little bit about models and how they're viewed, and how things have maybe changed over time and so on. So this is Mervyn King, and there are three videos that I'm going to refer to that he's made over the last couple of years and so on. One was going back about a year or so, where he basically argued that central banks had been infected by DSGE models in the profession. And because these models had presumed that expectations were anchored. And so I was quite surprised in that interview, because he basically argued that this wasn't a problem of the central banks, but this was a problem of the profession. And the way I would think about that is that we need to have much higher levels of transparency, because if central banks could get infected by the profession, by whatever the latest fad is in the profession, that we need very high levels of transparency to hold them accountable, to make sure that they don't get infected, and so on. And then the next video, actually, it's not a video, it's when he was at the Riksbank, where he made a really big deal that we need models with endogenous monetary policy credibility. And that reflected a complete lack of awareness of all the work that was done in FPAS central banks, developing models of inflation expectations. So where we started in the late 80s and early 1990s at the Bank of Canada was developing models with endogenous monetary policy credibility, because we're starting off in a regime where inflation expectations were much higher than the target. And we had to think about, how would the economy evolve? How would expectations evolve? How long would it take anchor long-term inflation expectations and to eliminate the inflation bias that was embodied in wage and price setting behavior. So I was a bit surprised. So we created a website that basically goes through, it references all the papers, all the central banks that we worked with, what we would describe as FPAS central banks. And what's really special about these FPAS central banks is that, and this started at the Bank of Canada, is to think about monetary policy as having three essential ingredients, like studying where the economy is today, okay, understanding what the forces are that are driving the economy, and lastly, and this is the thing that really got us going, thinking about modeling and effectively rejecting old style econometric models, which is what do we need to do with our instruments to achieve our objectives? And those instruments were not just the setting of the policy rate, which is how we thought about it 30, 40 years ago when monetary policy transparency was zero, where we would say little and let actions speak, but thinking about influencing the expected path of the policy rate, because that's what influences longer term interest rates and the exchange rate and so on. So as soon as we ask that question, what do we need to do with our instruments to achieve our objectives? We needed to develop models that were sufficiently compelling and convincing to policymakers to be used as an organizational device. Okay, so that's so that was kind of one response. Now, in the last couple of weeks, he's produced another video called "Our Economic Delusions," and in this video, he correctly argues that the problem that a lot of central banks face is that they think that they need to design a model to tell them what the answer is. Now, this is to a large extent a UK phenomena. When I was at the IMF, I once got a telephone call from the head of a parliamentary committee in the United Kingdom. And this was just shortly after the European debt crisis. There was a problem in the sense that a local government had made a bad investment. And instead of blaming it on the advisor that recommended that investment, they blamed it on the model. And that then led to a review, a mandate where they were going to review all the models in the United Kingdom, because if one model was responsible for losing all this money, taxpayer money, then we should evaluate all the models. And when I had a call with them, I expressed my surprise that this was simply the absolute wrong way of thinking about it, that models are tools. It's really the analyst and the economist that is responsible for using the tool. But Lord Mervyn King in this video basically says that in a lot of cases, people are trying to get out of models something that they shouldn't be trying to get. But I also need to note, very importantly, that this view that Lord Mervyn King is espousing right now, I would say most people like me in the business would have thought 30, 40 years ago. And I think you would say that virtually anybody that was educated at a good university would not be thinking that models tell you what the answer is. That's more of a UK tradition, I think, by people like econometricians like David Hendry and people like that. So I just wanted to say that Lord King, his perspective seems to be to a large extent very UK centric. They did manage to infect other institutions, and I saw that when I would be doing technical assistance to various central banks. Good example would be the Norges Bank. This applies to Brazil, Korea, Australia. A lot of these central banks were infected by this econometric approach to modeling and so on. So at the Norges Bank, so we rejected at the Bank of Canada. We got rid of those large-scale econometric models in the late 1980s and early 1990s. We developed methods for solving forward-looking models. And when we specified these models, we made sure that they had transmission mechanisms that were viewed as being sensible by policymakers and so on. So this is absolutely important. And of course, in those models, it was illegal to peg interest rates. So this convention that the Bank of England follows of doing a scenario where the interest rate is unchanged, that is not allowed in these models that we developed, because the purpose of designing these models was to show that the fundamental role of monetary policy is to adjust their instruments sufficiently aggressively to anchor the system. So obviously, if we had a model that you could solve with an exogenous path for the interest rate, wouldn't be consistent with that principle. Now, another very important part of this is complexity. So these very same types of issues have been raised by Ben Bernanke in the review of the Bank of England. And I just direct you to recommendation 4 and to maybe start the discussion a little bit. But it talks about that the revamped framework should include the following key elements. And of course, when you go down this list, I would say every good macroeconomist should be aware of all of these issues. But the idea that you would try to put all of these things into a core projection model would be extremely unwise. In fact, all of the successful modeling projects that I've advised on central banks over the years, a very explicit decision was made early on in the process about what to include in the core model and what to exclude in the core model, and to cover with things like satellite models or other types of models to consider those specific types of issues and so on. So I just wanted to say a few words in response to what Lord King is saying. We don't disagree with many of the things that he's saying right now. In fact, we agreed with them 30, 40 years ago. The problem with I think the United Kingdom and the Bank of England right now is that they lack the leadership to basically prevent being infected by these these fads that go on in our profession. And just quite frankly, the objectives of people in the academic profession are different than the objectives of people that are working in central banks. So in the economics profession, we need to worry about things like analytical tractability, and that points us towards linear models. But for policy analysis, we need to think about nonlinear models. We need to think about formulating judgment under uncertainty and so on. So there are big differences and reasons why academia should continue to do what they're doing now, which is to flesh out DSG economics, but why in policymaking institutions they need to realize that a lot of training needs to go on to prepare the students to go from that academic world to operating in a professional environment. But Giannis, would you have any disagreement about those thoughts in any way whatsoever?
No, I think I'm very much on the same wavelength as you on this. I think you very nicely explained or elaborated on some of my broader reservations that I had expressed. And in fact, as you know, FPAS Mark II and its explicit incorporation of uncertainty in policy making is a very important step and illustrates an appropriate use of models that steps away from some of the disadvantages of earlier practices.
So we can carry on with these issues on Thursday at the beginning of the session on Thursday, but today we have three Georgian students. They're new, fresh out of school. We have Tina and Lakasi and Sophie. And from the Central Bank of Armenia, we have Anahit. And on Thursday, we will have Deanna, Svetlana, and Annie. Okay, today we'll be applying it to the United States, I believe. Okay, but on Thursday they'll be applying a pass mark to the Euro area and the United Kingdom and so on. And then I think on Friday we're going to have Sylvie and Satinek. I pronounced her name correctly. I get a point. Maybe the very first time that I did it. But they're going to talk about potential output and the national rate of unemployment, how to think about measuring it, how the best of the best FPAS Mark 1 central banks, specifically the Reserve Bank of New Zealand and the Bank of Canada, they score pretty well in terms of how they think about potential and use the concept in real time and so on. So please, I think Tina is starting, but is that true, Tina? Or
yeah, should I start with the presentation?
yes.
Okay, I'll share my screen. One moment, please. Yeah, apologies about that. Can you see it?
We can, yes. Can you change slides?
Did it
Good.
change? Okay. Hello everybody. I'm Tina Antholadze. I'm an intern at NBG at the National Bank of Georgia, and I'm a student at the Global Forecasting School. As Doug said, I'm a bit of a novice, but I'll try my best to analyze US's current economy using the lens of FPAS Mark II. Just very briefly, because our YouTube channel is very focused on explaining what the FPAS Mark II entails, I won't go very deep into it. I'll briefly explain that it is a way of conducting monetary policy which ensures that there are least regrets. So it has three ingredients. It has three main questions. First being, where is the economy now? Second, what are the underlying forces? And third, what are the policy instruments that we need to achieve our goals? And in FPAS Mark central banks, the goals we have inflation targeting. But also we try to minimize the welfare losses of people, which is how it differs from FPAS Mark 1, in a sense that it takes onto this prudent risk management approach, wherein it provides different case scenarios and does not provide just only a baseline, and baseline can often be misleading and it does not pertain well to a central bank's credibility. So we have two main cases. So firstly, we have a market reference rate, which is another novelty of FPAS Mark II, because it is one of the first models which incorporate what the financial markets are thinking about the Fed funds rate, and what are they thinking about the current economy. And then around that, we have case A and case B. Case A is a scenario where we take into account what are the factors which might lead to a Fed rate, policy rate needing to be higher than what the market expects. And a case B is a plausible dovish scenario where we look into variables and some indicators which might lead one to think that maybe the policy rate needs to be lower than what the market has internalized. And the case X and Y scenarios are going into dark corners. Case X is case A deviating into a dark corner. Dark corner is a concept pitched by Olivier Blanchard. And case Y is going into a heavily dovish scenario where interest rate reduction would have been very, very harsh. This is how we can see it graphically. And right now I'll start answering the first question, which is, where is the economy now for the United States? I will not stop very long here. I'll just say that in the past multiple quarters, US economy has outperformed other developed markets, particularly Europe, and it also has outperformed most of the projections that many, like GDP now, has had. It was performing better than expected. And also inflation was declining more than expected in many cases. So it was looking like a soft landing scenario. But lately we've had huge turbulences with the carry trade, with the not so promising labor market outputs. But again, these are just volatilities, and most of the things seem to be going back to where they were in the stock markets. Now, however, when talking about the current state of US economy, one should take into account the political aspect of it all. There are huge speculations about Fed promising to lower rates just because to have an easing effect on the economy before the elections. And so this is one of the aspects that one must take into account coming from the Republican media. Now I'll go into discussing market reference rate. And for this, one must look at the SOFR path. And we see that the market, like you can deduce the neutral rate by looking at a long run SOFR expectations, and it is around 3.4. And another thing is that the margin, so the variability of the expectations is also huge. So there is a huge uncertainty about what the neutral rate will be, but what one can say that it is markedly higher than the 2.8, which comes from the Fed's dot plot. So a Fed should be very careful not to decrease the policy rate lower than very low, because if it is lower than the neutral rate, inflation will become unanchored. And when thinking about market reference rate, we can look at target range probabilities, and we see that the market expects sizable rate cuts. They expect a 50 basis point cut, which is huge. And right now, in discussing case A and B, I'll provide my outlook on what I think would be a reasonable way how a Fed should act. I'll start by looking at the most straightforward things that one must look at when thinking about case A's and B's. And the first thing is the Atlanta Fed's GDP now output. And here we see that it is true that the inflation, that the GDP growth has been revised downwards to 2%. But still, when you look at retail trade, we see that it is quite strong. When we look at wholesale trade, international trade, most of the hard variables are behaving very strongly, and also the CPI is higher than the target. And when we look more deeply into CPI output of just a few days ago, we see that services and shelter inflation is high, and service and shelter inflation are one of the best indicators of what is happening domestically. It is not confounded by external factors such as exchange rates or external demand. And given that shelter and service inflation is so high, and given that service inflation takes, I think, 3/4, like 70, I think about 70% of all inflation, it must be taken into account that there is a still strong inflationary forces on the market, especially when you look at how I don't think I have it here. It's here, especially when you look at sticky price CPI. It is true that it has been going down, but there has been a huge volatility, and still, despite it going down, it is still above target, despite flexible CPI being low. And sticky price CPI is one of the best indicators of future expectations about inflation because it incorporates prices that do not change very swiftly, and price setters, which are price setters of which do not set prices very frequently, are very careful into internalizing the market signals about increasing prices or not. So when we look at it being above target, it gives one a concern, like, is inflation really anchored or not? One of the best indicators for whether output is really increasing or not, whether we're in an expansion or not, as suggested by Pat Higgins, the author of GDP Now, is the growth rate of real final sales to private domestic purchases. And we see that the growth rate does not go below zero. If it goes zero, then one can suspect that we are not in an expansion. But unlike GDP, it does not go below zero. It is not that volatile, and it gives a case A scenario that the GDP growth will not decline, and we are in an expansion. Another indicator of case A scenario is that we have a demand pool, which can be seen by real personal consumption expenditures and real disposable income, both increasing without any significant downturns. Also, what you can see, I haven't plotted it, but you can see that the rate of increase in PCE is higher than the rate of increase in real personal disposable income. So it signifies a demand fall from consumer side. PCE services, again, one of the most important inflation indicator one must look at is services. And one of the most important expenditure that one can look at is PCE services. And we see that it is increasing, and we see that the rate with which it grows is stabilizing, despite having small fluctuations. Oh, I think I forgot to put it in, but when we look at durable goods, the consumption of durable goods is also very strong. Another reason why I think that we could be in a case A, which means that the policy rate needs to be higher than the one internalized in the market, is that the government has had huge debt, and there you can see that the debt to GDP ratio has been very high, and federal debt has also been very high, and it does not necessarily look like to be decreasing, even though there are promises of it and there are projections of it. We don't see it yet, and we see that a personal saving rate is declining. So it gives one a reason to look at it from a non-Ricardian outlook. And when you look at it in that way, you realize that it is probably true that people do not consider all the future repercussions that they might have if they do not increase their saving rate in response to increasing debt to GDP ratio. That people are conceiving all these input into the economy coming from the government as increasing their wealth, which is wrong, because later they'll be taxed for it and they'll have huge repercussions on it. And there are multiple models which look at it in this way, and they prove that when debt to GDP ratio goes up, the neutral interest rate goes up significantly as well. And one of the models is the multi-mode Mark III, which is authored by Doug Luxton, among others. So this is one of the reasons that I think it's more of a case A. Again, we can see that real personal consumption expenditure is relatively strong as well. These are the growth rates. And a thing that I want to talk about, which not many, I haven't heard many talk about it, is that people often say that savings are burnt out. Like there was an IMF estimate saying that people have used up the savings, they are going to use up more of it, but I don't believe it's the case. I think what happened during the pandemic was that personal savings rates surged due to large government income transfers, but as the crisis ended, income growth and savings rate normalized. Despite this, consumer spending was not supported by savings, as the personal savings rate never turned negative, and And therefore to claim that the consumers have spent up their savings is, I think, wrong. What I believe is that excess savings have contributed to overall household wealth. They have capitalized their savings, they have invested their savings, which can be seen on the second graph, where we see that net increase in household net worth has surpassed the cumulative savings. So they have put their savings into some stocks and bonds, and which can also be seen the huge household wealth increase of over 50 trillion. And as a paper by Doug and Mariam Chanturia posits, consumption is a function of household wealth, disposable income, and expected disposable income. And so again, we can still have projections that consumption will not decline. Another thing that I want to point out is that I don't think households will be harmed by high interest rate, because debt to disposable households dependence on debt has significantly declined after the 2008 crisis, and right now it's on a 25-year low. So thinking that households will be harmed greatly is not a huge argument. An argument for a case B would be that discrepancy rates are a little bit high. But again, we see that the credit market is rather strong. I will spend a bit of time on labor market because it was the thing that put the economy into turmoil. So one of the things that one will hear very often by economists analyzing the US economy is the SAM rule, which is a rule that says that if the 3-month moving average of the unemployment rate rises by 0.5 percentage point over a 12-month period, it will indicate an onset of recession. And it is true that it has not made a mistake with previous recessions, but the thing with elevator economics that we are so avidly taught at GFS is that one shouldn't just look at an indicator and say, oh, that's it. When you look at it from another view, when you look at, for example, payrolls, which also caused an uproar, like, oh, we are probably having a really weak labor market, was that payrolls are declining. But but I think it's just normalizing. The payroll growth of I think it was 100,000 would have been normal before COVID. It's just normalizing to before COVID estimates. And given that, I'm skeptical about SAM rule predicting a recession, because like when we look at, for example, job openings, yes, it is declining, but again, it is significantly higher than the pre-COVID estimates. And when we look at layoffs, you cannot say that they are increasing, they are decreasing. And when you're looking at quittings, they're also going down. So what is happening is that there is a labor supply increase, not necessarily a quitting or firing. There is just labor supply increasing from immigrants. There is labor supply increasing from people returning to market. And when another thing is that the current labor situation differs from previous periods, because historically wage growth and job vacancies usually used to decline when there was a policy rate hike. And in this case, it is not true. It happened because there are some different driving forces, such as increase in labor supply. I think it's enough for now about this. According to GFS estimates, we think that unemployment gap will close if it is closing, and we shouldn't be afraid of having a too high unemployment, at least at this point. And here we can see that average hourly earnings growth is significantly higher than the pre-COVID estimates. We're still really high. Another reason why I have a positive outlook about the labor market is that the huge growth of the growth of 4.3% came, I think, quite significantly from the hurricane in Texas, which made it such that people could not work because a lot of firms closed down. But when we look at initial claims is lower than was expected from that huge hurricane. So again, I think even from that perspective, labor market is strong. Now I'll go into my case B scenarios. And the one thing that I want to look at, the first thing that I want to look at is the investments. So usually people are saying that given that consumption is strong, there will not be a recession. But when you look at previous recessions, consumption was quite strong in many cases. What was not strong was real non-residential investment, fixed investments. Even business investments were strong, but non-residential investments were weak preceding the recessions. And unfortunately, this is what we are seeing, right now. So this is the graph for it. So real private residential investments are, so not non-residential, the real private residential investments tend to decline before recessions. And unfortunately, this is what we are seeing now, but it is not the strongest indicator. Another argument that people have about a recession is that had it been a demand-driven inflation back in 2021, then when the Fed rate hike happened, the impact on inflation would have been later. But for some reason, the impact on inflation was quite soon. It declined as soon as the Fed rate, like just a few months after the Fed rate hike happened. But what one must think about it is that it was not just a demand side inflation, it was both demand and supply side driven, and there were both forces. But it's an argument for a case B that maybe it wasn't a demand driven, it was just a transitory inflation, and that's why the decline in inflation was so swift after the rate hike. There are also studies by Shapiro, who studied that, I think it was in 2022, who looked at 124 categories and found that most of the inflation was supply side driven. He looked at supply goods and saw that inflation reduced because quantity supplied increased. And another arguments that case B people tend to have is that in supply side, the impact on supply side gets translated into PC inflation quite late, so 3 to 4 quarters later. So that's why we saw what we saw in price increases coming from supply side. Now I'll talk about the carry trade unwind, which is a hot topic. So we saw Bank of Japan's policy rate hike happening in, I think, 17 years for the first time, and that caused an uproar on the stock market. So I'll really swiftly explain the carry trade. So the idea is that when a country has a really low interest rates, people have an advantage of borrowing money there and then investing it in countries like United States or Australia, for example. It was very popular as well, and reaping the high interest rate returns on either bonds or stocks. So a lot of money, it's not estimated yet. It's not, we don't know exactly how much is in carry trade, but it's quite huge. I'll talk about later. And it also happened with ECB in rising policy rate in 2023 as well, when it had quite a hit on VX-US. So that's the effect that it had on it. And the carry trade unwind, which happened just a few days ago, also had a huge impact on the S&P 500. And we can see that in previous periods, whenever the yen USD appreciated, we saw a decline in S&P 500. So it has always been something that one can look at. And right now, we cannot say exactly what the effect of this carry trade thing will have, because some people say that maybe carry trade is as big as $4 trillion. Some are saying that it's maybe $500 billion. And we can see that there is a huge correlation between yen USD and US unemployment rate. We see that whenever yen USD appreciated, unemployment rate hike happened, and it's a thing. But I think it was the shock on the stock market did not only come from carry trade, it was concurrent with the labor market data. So it's quite questionable if it was only from carry trade. Another case B argument is that, so the carry trade argument is that if yen keeps appreciating, people will invest less and less in US because they no longer have the advantage of borrowing at a low rate in Japan and investing in the United States. So another case B argument is that, and I believe that, is that I do not think that the hype on generative AI is sustainable. I do not think that all the investments in AI is sustainable because I think it's similar to whatever happened in the 90s with the dot-com bubble. There was a study in 2024 by Darren Akamelogu, I'm probably saying it wrong, according to whom total factor productivity and GDP growth will be about 0.66% and 0.93% respectively over 10 years as a result of the AI. And even if he's quarter right, this is not a huge enough increase in productivity to invest so much in AI and to have such hopes on AI. And we see that the US technology sector is very volatile. So maybe the investors have internalized that, oh, we are overinvested and there is a bubble there. This is why we saw a huge decline after the unemployment data and the yen appreciation. It declined quite dramatically. It had a record drop of 65 billion, from 65 billion to 55 billion, but it went up quite swiftly as well. And the tech companies are very important because they comprise 30% of S&P 500, which is huge. And when we look at it, it had a rebound, but then again, this volatility is very scary for the markets. This is a graph by, I don't have the source, but it's not my graph. I couldn't make it. Another case B is like why it's a good argument, I think, is that the PE ratio, which basically tells you how overvalued a stock is quite huge for the big seven. This is S&P without big seven. This is the big seven, and we see that it is highly overvalued, and this is very scary because it indicates a bubble, and historically technology stocks have shown consistent or outperformance, but and so maybe one can say that it will keep outperforming, but then again the volatility is very huge right now, and I think they're vulnerable, the tech companies. There is also huge fears on the market. When you look at the Google searches for the 10 recession, it has gone up by a huge margin. It hasn't been that high since 2020. And when we look at the volatility index, it also had a huge hike, and historically, huge hikes in volatility index are linked to declines in S&P 500 index. And also, 1 week ago, Goldman Sachs raised recession risk from 50% from 25%, but like 1 day ago, on 18th of August, they said that we are reducing it from 25 to 20%. So there is a huge volatility on the market. And also the thing about why one might not think that this VIX index will go down, so it has gone down, but it will stay down, is that the Fed rate translates into high VIX index with a lag. And we don't, this is month on month, this is monthly VIX index, and we don't see that hike. So I think this hike in VIX index is coming, and I think the risks that we see on the stock market and the bubble risks are solid, and given the huge volatility, and given that I do not believe that the AI deserves as much hype as it does, I think that it is reasonable for Fed not to rise the interest rates, and it should go as it has promised and decline it. But I don't think the decline of 75% is reasonable. I don't think the decline of 50% is reasonable. I think the decline of 25% will be sufficient. I think a decline of huge amount, not only would it be lower than neutral rate, but it would also cause havoc on the financial markets. Financial would think that there's a central bank information, they're reducing it because they're expecting recession. So I don't think it would be reasonable to reduce it very much. Thank you so much. That was my presentation. I think I went over time. If you have questions, I'll be able to answer.
Yeah, Giannis, we want to respect, work-life balance issues and stuff. So I think just ask her a couple of questions, and we'll carry on with the other two presentations on Thursday, and then just carry on and so on. But Giannis, do you have any questions for Tina?
Tina, thanks very much. This was quite informative and a detailed assessment there. As we know, I mean, I would emphasize that yes, your emphasis on asset prices, I think, is particularly well placed. Consumption itself seems to be driven a lot, or in recent years, by household wealth, which in large part reflects the surge in asset prices. You focused very much on the stock market, and the question there is obviously the market has been placing faith until recently, at least, on the supply side, maybe due to AI, maybe due to other productivity developments. Do you have a similar analysis on house prices? Because historically, house price bubbles and house price declines have had a much more significant effect on the macroeconomy than stock price movements. I would be very interested if you had done a similar analysis there.
So I have not updated, unfortunately, but as I remember, the housing market is also quite strong. I don't think there is necessarily a bubble, but it seems to be prices seem to be quite high, and the new homes built are also very significant. But it could also be pointing to people having good expectations and them being calm and not expecting a recession. Same with investing in durable goods. So there could be a bubble. I haven't thought about it, but I agree that housing market is also very strong.
Okay, so I guess thank you so much, Giannis, for your reflections, and Tina for the wonderful presentation. I think we should give her a hat. Actually, it was a wonderful presentation. So Tina has been with us for like how many months?
What, 2 or 1, 2?
2. You can't even remember how long it's been. So thanks, Tina. Unfortunately, we won't have time to talk to Lacassie and to Sophie, but and Nanahid had to run to a meeting. So, but we'll catch up on Thursday and just carry on. But very nicely done. So it's interesting to see you guys progress so rapidly. That's quite shocking, actually. So congratulations. Thanks, Giannis, for all your
Sure,
help.
Doug, and thank you so much, Tina. Again, this was quite an impressive presentation. I learned a lot on my side, so it was very valuable to me as well. It's
Thank
great
you
to
so
see you all again after all these weeks.
Thank you so much. I appreciate it, and thank you, Johannes and Doug, for like the opportunities that I have, and I really truly learned a lot, and I look at things differently compared to how I used to, and thank you too.
See you later.